I'm about to share some simple MACD strategies that are easy to follow, work in all markets, and have a high win rate. These tips can help you make more money while trading. Let's dive straight into it. First, I'll guide you through some of my favorite advanced MACD strategies, and at the end, I'll reveal my top strategy, so make sure to stay tuned. To get started, open TradingView, go to the Indicators tab, and search for MACD. Once you click on it, the indicator will appear at the bottom of your chart. You'll notice three key components: the blue MACD line, the orange signal line, and the histogram represented by bars. These elements help identify bullish and bearish signals in the market. Now let's understand how the MACD indicator provides us with buy and sell signals. I'll tell you 4 ways to know when the MACD indicator gives buy and sell signals. Let's start with the first one. The first way is to watch for crossovers between the MACD line, blue, and the signal line, orange. These crossovers often signal whether to buy or sell. First, let's talk about the buy signal. When the MACD line crosses the signal line upward, it indicates bullish momentum, suggesting the stock might rise. If you see the blue MACD line cutting the orange signal line upward, it's a sign that the stock is giving a buy signal. On the other hand, a sell signal happens when the MACD line crosses the signal line downward. This indicates bearish momentum and suggests the price might start falling. If the blue MACD line cuts the orange signal line downward, it shows the stock is likely to give a sell signal. After this, the price often drops, as you can see in the chart examples. In summary, whenever there's a crossover, if the MACD line cuts upward, the price is likely to rise. If the MACD line cuts downward, the price is likely to fall. This is the first way to use the MACD indicator to identify buy and sell signals. Let's move on to the next ones. The second way to identify buy and sell signals with the MACD indicator is by observing how the MACD and signal lines interact with the baseline. Whenever the MACD line and the signal line cut the baseline, which is the zero line, upwards, it signals a potential buying opportunity. This indicates that momentum is shifting towards bullishness, and the price is likely to rise. On the other hand, when the MACD line and the signal line cut the baseline downwards, it generates a sell signal. This downward crossover suggests bearish momentum, and the price is likely to fall. For example, as shown in the chart, when the MACD and signal lines break above the baseline, the stock tends to move higher. Conversely, when they cross below the baseline, the price often starts to decline. By keeping an eye on these baseline crossovers, you can spot clear buy and sell opportunities in your trading strategy. The third way is the MACD double top and double bottom pattern. If there is a double top pattern on the chart, there's a chance for the share price to fall. If there's a double bottom pattern, there's a chance for the share price to rise. Let me explain this with an example. The MACD indicator was increasing. After that, it made its first top here. Then the MACD line went down a little. After that, it increased again and made its second top here. When both these tops are made, there's a high chance for the trend to reverse. You can see that after this, the price has fallen. Similarly, whenever there is a double bottom pattern in the MACD, there is a chance for the price to rise. For example, here, you can see the MACD indicator was falling. Then, it made a bottom. After that, the MACD increased a little and fell again. If it made the first bottom, it made the second bottom near it. When two bottoms are made like this, there's a high chance for the price to increase. As you can see here, after this, there was a strong uptrend in the share price. These patterns can help you predict reversals and make informed decisions about potential market movements. The fourth method is histogram and MACD divergence, a powerful tool for identifying potential trend reversals in the market. Divergence can be categorized into 2 main types: bullish divergence, also called positive divergence, and bearish divergence, also called negative divergence. First, let's discuss bullish divergence. If the price of the stock is falling, the MACD is also declining, but the histogram starts moving upwards. This indicates a divergence in the histogram. Such a divergence suggests that there may be a reversal, and the price is likely to increase. As shown in the chart, the price indeed went up after this divergence. This is known as bullish divergence. Now, let's move on to bearish divergence. Bearish divergence is the opposite of bullish divergence. If the price of the stock is rising, and the MACD is also increasing, but the histogram is falling, this indicates a negative divergence. Following this, there's a higher chance that the price will decrease, which is exactly what happened in the example provided. So, now that we've covered histogram divergence, let's explore MACD divergence. Typically, the price of a stock and the MACD move in the same direction. For instance, if the price is falling, the MACD will also decline. However, if you notice that the price continues to fall while the MACD begins to rise, this signals bullish MACD divergence. This suggests a potential reversal, with the price likely to increase. On the other hand, if the price is rising but the MACD begins to fall, this indicates bearish MACD divergence, suggesting a possible price drop. When trading with MACD divergence, it's essential to combine this strategy with other analysis methods to confirm the signals before making any trading decisions. This multifaceted approach helps increase the accuracy of your trades. Let's go over trading strategies and how to use them. I'll explain each step clearly, including setting stop losses, taking profits, key points to watch for, and mistakes to avoid. Stick around to get the full picture and improve your trading. The MACD buy strategy is a straightforward way to enter long trades during a bullish market with strong momentum. It combines the MACD indicator with the 200-day moving average to improve accuracy and reduce false signals. First, check the market trend using the 200-day moving average. If the price is above it, the market is in an uptrend, and you should only consider buying. Look for a bullish MACD crossover, where the MACD line crosses above the signal line. This is most reliable when it happens near or below the zero line, signaling the start of upward momentum. To strengthen your decision, confirm the setup by identifying support levels where the price has bounced before. Enter the trade if the MACD crossover occurs near these levels and the price stays above the 200-day moving average. Place a stop loss slightly below the recent swing low or support level to limit losses. Set a profit target based on resistance levels or use a 3-to-1 risk-to-reward ratio. A trailing stop can help secure profits as the price moves higher. Be patient and only trade when all conditions are met. Stick to risk management by only risking what you can afford to lose, ensuring long-term success. The MACD sell strategy is a simple approach for entering short trades during a downtrend with strong momentum. By combining the MACD indicator with the 200-day moving average, it helps improve accuracy and filter out false signals. Start by identifying the market trend using the 200-day moving average. If the price is below it, the market is in a downtrend, making it suitable for short trades. Ensure the price stays below the 200-day moving average to align with the bearish trend. Wait for a bearish MACD crossover, where the MACD line crosses below the signal line. This is most effective near or above the zero line, indicating the start of strong downward momentum. Avoid crossovers far below the zero line, as they may suggest a weakening trend. Confirm the setup by checking resistance levels where the price has previously struggled to move higher. If the crossover aligns with these levels and the price remains below the 200-day moving average, it's a strong signal to enter a short trade. Manage the trade by placing a stop loss slightly above the recent swing high or resistance level to protect against reversals. Set a profit target based on nearby support levels or use a 3-to-1 risk-to-reward ratio. A trailing stop can help secure profits as the price moves in your favor. Trade only when all conditions are met, and maintain disciplined risk management by risking only what you can afford to lose. This ensures consistent results while capitalizing on bearish trends. Divergence is a strong signal that prices may reverse, but not every divergence is worth trading. To improve the odds of success, focus on key reversal zones and look for divergence within those areas. One way to spot these zones is by using support and resistance levels. Start by identifying major support and resistance on higher time frames, like the 4-hour or daily charts. Then, switch to a lower time frame, such as the 1-hour chart, to confirm divergence at these critical levels. Let's walk through a bearish divergence setup. On the 4-hour chart, the price moves up and starts to reverse, forming a clear resistance level. We focus on this level for the trade setup. When the price returns to this resistance zone, it could reverse again, creating a potential selling opportunity. Now, we switch to the 1-hour chart to look for divergence. On the 1-hour chart, the price forms a higher high near the resistance level. Initially, this looks bullish, but the MACD shows a lower high, classic bearish divergence. This indicates that, while price is still rising, buying momentum is weakening. The market is losing strength at the resistance level, suggesting a downside reversal is likely. With both the resistance level and bearish divergence confirming the setup, we now have a high probability trade, signaling a potential sell. To confirm the entry, identify the lowest point between the two peaks on the MACD histogram and draw a horizontal line at that level. When the histogram drops below this line, it confirms that selling momentum has overtaken buying momentum. This is the signal to enter the sell trade on the next candle. To manage risk, place the stop loss just above the most recent swing high or slightly above the resistance level. This ensures that if the market moves against us, losses stay controlled. For take profit, set the target at the next significant support level, where price may reverse again. If the price reaches this level, either take profits or reassess the situation based on price action. By following this strategy, we see a sharp downward move after entering the trade, confirming the validity of the bearish divergence setup. As the price nears our take profit target, we continue to monitor the market. The downward movement matches our analysis, showing how combining resistance levels with divergence helps identify high probability trading opportunities. Let's look at how to apply the same principles in a bullish scenario. In this case, we're setting up for a buy trade. Like the bearish example, we first identify a support level on the 4-hour chart, where the price has previously reversed or consolidated. When the price revisits this support zone, we expect it to hold and the price to rise. To refine the entry, we switch to the 1-hour chart and look for bullish divergence. This occurs when the price makes a lower low, but the MACD forms a higher low, signaling that selling momentum is weakening. As the price nears the support zone and we spot this divergence, we can start to expect a reversal. To confirm the setup, mark the highest point between the two lows on the MACD histogram and draw a horizontal line. When the histogram breaks above this line, it signals that bullish momentum is taking over. To manage risk, we place a stop loss just below the recent swing low, ensuring that if the market moves against us, our loss is limited. For take profit, target the next resistance level, such as a previous high. The price rises, confirming the trade as momentum shifts. Combining support, resistance, and divergence creates a high probability setup, with stop loss and take profit levels managing risk and securing profits. Let's get into the third strategy. In this one, I'll be using 3 powerful tools: the 200 EMA, the MACD, and the parabolic SAR to guide our trades. We'll start with a real chart example so you can see exactly how this works. The first thing we need is for the price to be above the 200 EMA, which confirms that the market is in an uptrend. This means we'll only be looking for buy opportunities. Trading with the trend is key, as it significantly increases the chances of success. Once the price is above the 200 EMA, we wait for the MACD line to cross above the signal line. This crossover is an important signal that momentum is shifting upwards, indicating that the market is gaining strength, making it the perfect time to enter a buy trade. Next, we need the parabolic SAR dots to be below the candles, confirming that the trend is still bullish. The parabolic SAR helps us stay in the trade as long as the trend remains intact, offering that extra confirmation to support our long position. When all these elements align, we know it's the right time to take the trade. The 200 EMA confirms the trend, the MACD shows momentum, and the parabolic SAR confirms the uptrend. Now let's talk about managing our risk. We place our stop loss at the most recent parabolic SAR dot, which represents the last low of the uptrend. This helps protect us if the market moves against us. For take profit, we aim for a 1.3 risk-to-reward ratio. For example, if our stop loss is set a certain distance away, we set our take profit 3 times that distance in the direction of the trend. Once you've entered the trade, it's crucial to monitor it closely. If the MACD line crosses back below the signal line, or if the parabolic SAR dots flip above the candles, that's our signal to exit. However, if the conditions remain the same and the trend is still strong, we let the trade play out and wait for our take profit to hit. Now that we've covered the buy side, let's look at how this strategy works for sell positions. For a sell trade, we do the opposite of what we did for a buy. First, the price needs to be below the 200 EMA, showing that we're in a downtrend and should focus on selling. Then, we wait for the MACD line to cross below the signal line. This tells us that momentum is moving down, which is a good time to sell. Lastly, the parabolic SAR dots should be above the candles, confirming the downtrend. When all these things match up, It's time to enter the trade. To protect ourselves, we place the stop loss at the most recent parabolic SAR dot above the candles. This shows the last high of the downtrend and keeps us safe if the market moves against us. For take profit, we use the same 1.3 risk-to-reward ratio. Monitor the trade closely. If the MACD line crosses back above the signal line, or the parabolic SAR dots move below the candles, it's time to exit the trade. If nothing changes, let the trade run and wait for your take profit to be hit. Now, let's look at the fourth strategy, combining trend lines with the MACD to increase trading accuracy. Before we dive into the real example, let's quickly revisit the concept of trend lines. Trend lines are tools traders use to identify and follow the direction of a trend. In a downtrend, we draw a line by connecting two or more lower highs, while in an uptrend, we connect two or more higher lows. This line acts as a visual guide, helping us spot potential reversals or breakout points. If you're not familiar with trend lines and the strategies behind them, don't worry. I've made a detailed video covering everything. You can find the link in the description, so be sure to check it out. In this strategy, we draw trend lines on the MACD. To make it simple, I've used a real chart to show how it works. On this chart, you'll see the MACD in a clear downtrend, forming a high and then a lower high. Following the same trend line principle, we connect these 2 points on the MACD to form our trend line. Remember, the first high must be above the zero line, and the second below it. Once the trend line is in place, we wait for a bullish crossover. Here on the chart, you can see the MACD line crossing above the signal line. But that's not enough. Look closely as both the MACD line and the signal line break above the trend line you've drawn. This is your entry signal. Now, let's manage the trade. Place your stop loss just below the most recent swing low visible on the price chart. This ensures your risk is controlled. For the take profit, aim for a 1.3 risk-to-reward ratio, or target the nearest resistance level for a safer exit. From there, the trade progresses as planned, following the strategy and market conditions. Now, let's quickly dive into the sell-side setup. Imagine we're analyzing a chart where the MACD is in an uptrend, forming a low followed by a higher low. To spot this, we connect those 2 points with a trend line on the MACD. Remember, the first low must be below the zero line, and the second low must be above it. This is important because it indicates that bullish momentum is weakening, signaling a potential shift to bearish momentum. The key signal comes when the MACD line and the signal line cross below the trend line. In this example, this happens just as the price stalls near a resistance zone, adding extra confirmation. This is when you'd consider entering a short trade. To manage your trade, place your stop loss just above the recent swing high on the price chart. This ensures you're protected if the price reverses unexpectedly. For take profit, I recommend a 1.3 risk-to-reward ratio, or if you spot a support zone below, set your target there. In this case, the price drops and hits the support zone, completing the trade successfully. Now, let's explore another strategy with a slight variation. This time, we will focus on drawing the trend line on the chart, not on the MACD. To execute the buy strategy effectively, start by identifying an uptrend. An uptrend happens when the price consistently makes higher highs and higher lows, showing that buyers are in control. To visualize this, draw a trend line connecting the higher lows. This trend line acts as a dynamic support level and helps confirm the market's upward direction. Next, use the MACD indicator to strengthen your analysis. Wait for a bullish crossover, where the blue MACD line crosses above the red signal line. This signals a potential shift in momentum toward buyers. Place your stop loss just below the recent swing low to protect your position. For the take profit, aim for at least 1.3 times the risk you are taking. You can also align your take profit with a key resistance level to maximize potential profits. To use this sell-side strategy, first, look for a downtrend. A downtrend happens when the price keeps making lower highs and lower lows, showing sellers are in control. Draw a trend line connecting the lower highs. This trend line acts as a resistance level and confirms the market is moving down. Next, use the MACD to confirm the trade. Wait for the blue MACD line to cross below the red signal line and make sure the histogram turns red. This shows selling momentum is building. Enter the trade when the price touches the trend line and the MACD gives a bearish signal. Place your stop loss above the recent swing high to protect your trade. set your take profit at least 1.3 times the risk, or near a support level. Keep an eye on the trade and move your stop loss lower as the price drops to secure profits. This simple method helps you trade with the trend while managing risk and locking in profits. But before we get into my favorite strategy, if you found this video helpful, please take a moment to subscribe to my channel. It would mean a lot to me and help you stay updated with more content like this. Now let's get into my favorite strategy. This strategy uses 3 indicators: the stochastic RSI, and MACD. We begin with the stochastic RSI, which provides the primary signal for trade entries. This tool is simple yet powerful, as it identifies overbought and oversold conditions in the market. It has 2 lines, a blue line called %K and an orange line called %D. Many traders make the mistake of using the stochastic RSI alone, buying when it signals oversold or selling when it signals overbought. However, this approach can lead to more losses than wins. Instead, it's essential to pair the stochastic RSI with other indicators for better confirmation. The second indicator in this strategy is the RSI, which is another popular tool for identifying overbought and oversold conditions. Since the stochastic already serves this purpose, we use the RSI differently here, to confirm the market trend. Adjust the RSI settings to show a single line at the 50 level. When the RSI is above 50, it indicates an uptrend, so you should focus on buying opportunities. When the RSI is below 50, it signals a downtrend, meaning selling opportunities should be your focus. The third indicator we use is the MACD, which helps measure market momentum. While many traders rely on MACD crossovers, buying when the MACD line crosses above the signal line and selling when it crosses below, this works best in trending markets and can give false signals in sideways markets. However, in this strategy, the MACD is not used as a standalone indicator. Instead, it is used to confirm that market momentum aligns with the trade direction. To identify a buy signal, follow these steps. Start with the stochastic RSI. Wait until both the %K and %D lines enter the oversold zone, suggesting a potential upward movement. Then, check the RSI to confirm the trend. Ensure it is above 50, indicating a bullish market. Lastly, verify momentum with the MACD. Wait for the MACD line to cross above the signal line, confirming upward momentum. Before entering the trade, double-check that the stochastic lines haven't yet reached the overbought zone, as this could indicate an overly bullish market. If all these conditions align, you can confidently enter a buy position. To manage your trade, set your stop loss just below the nearest swing low, which is the most recent low point in the market. Next, set your profit target to be 3 times the distance of your stop loss. This way, you keep a good risk-to-reward ratio, helping you protect your account while aiming for bigger profits. Finding sell signals follows a similar process to identifying buy signals, but in reverse. Start by checking the stochastic indicator. Wait for the %K and %D lines to reach the overbought zone, which suggests the market may be preparing for a downward move. Next, use the RSI to confirm the downtrend. Ensure the RSI is below the 50 level, indicating bearish market conditions and a likely downward trend. After confirming the trend with the RSI, check the MACD to validate momentum. Wait for the MACD line to cross below the signal line, signaling that downward momentum is building. Before entering the trade, double-check that the stochastic lines have not yet reached the oversold area, as this might indicate the market is becoming too bearish and near a potential reversal. Once all these conditions align, you can confidently enter a sell position. To manage your trade, place your stop loss just above the nearest swing high, which is the most recent high point in the market's price movement. Then, set your profit target at 3 times the distance of your stop loss. This keeps your risk-to-reward ratio in check, helping you protect your account while aiming for bigger profits. If you're ready to take your trading to the next level, don't miss the next video. In just 10 minutes, I'll show you how to master trend lines and use advanced strategies like we covered today. Click here to watch it now, and I'll see you there.